In the world of banking and finance, there exists a system known as fractional reserve banking. It involves a complex process through which commercial banks lend out more money than they actually have on hand. While this practice may seem a bit perplexing, its effects on the value of the dollar are worth considering. To better understand fractional reserve banking, let's imagine a scenario. Suppose you deposit $1,000 into your bank account. Under fractional reserve banking, the bank is only required to hold a fraction of your deposit as reserves, which means they can lend out the rest. In this case, let's say the reserve requirement is set at 10%, meaning the bank needs to keep just $100, 10% of $1,000 in reserves, while the remaining $900 can be loaned out to borrowers. Now, let's assume someone comes along and borrows that $900. They then spend that money on goods and services, which in turn ends up being deposited into other bank accounts. At this point, the process repeats itself. The bank keeps 10% of this new deposit as reserves and lends out the rest, creating new money in the process. This cycle continues, and as more loans are made, more money is created, leading to an expansion of the money supply. This expansion plays a crucial role in the reduction of the value of the dollar. When there is an increase in the supply of money in circulation, each individual dollar becomes worth less overall. This occurrence is known as inflation. However, it's important to note that inflation is not solely caused by fractional reserve banking, but is influenced by various factors such as government monetary policy, consumer spending, and economic growth. Fractional reserve banking plays a role in this process by contributing to the expansion of the money supply, which can ultimately lead to inflation. Fractional reserve banking has both advantages and disadvantages. On the positive side, it allows banks to provide loans financing economic growth and investment. It also helps to maintain liquidity within the banking system, providing stability during periods of financial stress. Additionally, it enables banks to earn interest on the loans they make, contributing to their profitability. On the other hand, fractional reserve banking carries certain risks. One significant risk is that it creates the potential for bank runs. If a large number of depositors were to withdraw their money simultaneously, banks may struggle to meet these demands since they only hold a fraction of their deposits as reserves. This situation can lead to a crisis of confidence, causing panic and instability within the banking system. Moreover, critics argue that fractional reserve banking allows banks to create money out of thin air. They assert that this practice promotes excessive lending and credit creation, which can lead to economic bubbles and financial crises. These concerns have led some individuals to advocate for alternative banking systems that operate without fractional reserves. In summary, fractional reserve banking is a system where commercial banks lend out more money than they actually have in reserves. This practice contributes to the expansion of the money supply and ultimately affects the value of the dollar by potentially leading to inflation. While fractional reserve banking has its advantages in terms of stimulating economic growth and bank profitability, it also carries risks such as bank runs and financial instability. As with any complex system, there are ongoing debates about the benefits and drawbacks of fractional reserve banking, and its impact on the value of the dollar remains a subject of discussion.